Let's dive into this, because today we are tearing apart a hidden legal trap in securities-based lending. And honestly, most borrowers don't even realize they're walking right into it. We are talking about the absolutely critical, fundamental difference between a borrow pledge and a repo. Most folks approach securities-based lending simple as a straightforward question of collateral, loan-to-value ratios, and interest rates, right? They kind of treat the legal structure holding it all together as just mere administrative detail. But as the 2008 crash proved so brutally, in a stress event, that assumption can be incredibly expensive. The real danger back then wasn't just market volatility. It was counterparty failure, specifically lender insolvency. When the dust finally settled, the legal structure alone dictated who got their assets back and who literally lost everything. So, to untangle this web, let's move through and see how this builds. We'll look at 1. The hidden collateral trap. 2. Who actually owns it. 3. The worst-case scenario. 4. Operations and hidden chains. 5. Why lenders push repos. And finally, 6. A real-world family office scenario. We're going to break down all this complex jargon logically, step by step.
Section 1. The hidden collateral trap. Because this is about way more than just LTV and interest rates.
Imagine this. You can have two loan facilities that look structurally identical on paper, but they end up producing materially different, even devastating outcomes when markets panic. Borrowers usually hyper-focus on those LTVs and rates, but the real structural risks are lurking right below the surface. Ask yourself, can your lender liquidate your assets without court approval? Can your collateral actually be sold to a third party during the term? And the big one, what's your recovery position if the lender itself fails? That right there, that is the trap. Which brings us to Section 2, who actually owns it, the critical difference in title. This is the first core axis of our blueprint, legal ownership, and it is arguably the most important comparison we're going to make today. In a borrow pledge, you retain legal ownership of your securities throughout the entire loan term. The lender just gets a security interest, a lien. But in a repo, a repurchase agreement, legal title transfers to the cash lender outright on day one. You literally just sold them your assets. You only hold a contractual right to buy them back later. So I want you to repeat this anchor mantra with me. Repo equals title transfer. That single distinction drives every material difference in your risk exposure from here on out. Section 3, the worst-case scenario, default and insolvency mechanics. Okay, so we know who owns the title, but what happens when someone actually defaults? Welcome to the terrifying world of lender insolvency. Before we look at a crash, we need to define the GMRA, the Global Master Repurchase Agreement. Now, what's really interesting about this is how it formalizes some incredibly aggressive mechanics. It allows for what's called closeout netting. This means if a default happens, all outstanding repo transactions can be terminated and netted simultaneously into a single cash obligation, completely bypassing any need for court approval. Let's contrast that. Under a pledge default, you get an automatic stay. It's a highly protected, closed loop with strict court supervision. But under a repo default? Well, because the title already transferred, the lender enforces immediately. Zero procedural delay. None. And if the lender fails, your assets are trapped in a totally disorderly failure. So the crucial point is this really harsh reality. In a repo lender failure, you are merely an unsecured creditor with a contractual right. You do not have a proprietary claim. In 2008, this asymmetry became brutally visible. Counterparties failed, and repo borrowers woke up to the terrifying realization that they didn't actually own their collateral anymore. They were just standing in line begging an insolvent estate for cash. Let's move to Section 4, Operations and Hidden Chains, Settlement Mechanics and Exposure. Let's explore the hidden mechanics of what happens to your securities during a normal loan term. That brings us to a massive vocabulary word you really need to know, rehypothecation. Because the cash lender owns your securities in a repo, they can freely reuse them. It's a bit like giving your car to a valet only to find out they're renting it out as an Uber while you're at dinner. Rehypothecation is a fundamental structural feature of institutional repo markets. Your lender is actively injecting your securities into a highly complex institutional web. Notice how this chain is built. First, you transfer title to the cash lender. Then, that cash lender rehypothecates your assets to fund the cash they literally just gave you. Finally, your securities move to a third-party counterparty entirely. While a pledge is a nice, segregated, bilateral relationship, a repo creates an infinite chain. If that third party at the end of the chain fails to deliver, your contractual right to get equivalent securities back, it could be severely delayed or completely constrained. This chain effect even impacts everyday operations, like margin calls. Now, in practice, receiving a margin call feels identical across both structures, right? You just have to post more collateral. But legally, completely different. A pledge margin call is just a demand under the loan facility. A repo margin call is a contractual variation under that aggressive GMRA we discussed earlier. One missed margin call in a repo, and it's game over immediately. It triggers a fatal closeout netting event. And this brilliantly illustrates our operational axis. Stacking them up head-to-head, the contrast just couldn't be starker. For custody, pledge is segregated, while repo is commingled on the balance sheet. For default action, pledge has an automatic stay, repo has immediate closeout. And for lender failure claim, pledge gives you a proprietary claim to your actual assets, but repo, it leaves you as an unsecured creditor. Section 5. Why lenders push repos. Structure follows infrastructure. So, if repo is so inherently dangerous for the borrower, why is it so incredibly common? Well, the truth is, lenders aren't choosing structures based on what's convenient for you. Dealers and prime brokers use repos to reduce their Basel III capital requirements and activate reuse revenue. For a large institutional dealer, repo isn't just a menu option. It's how their trading book infrastructure physically operates. They literally need your title. On the flip side, private banks and SBL specialists strictly stick to the safer pledge or Lombard loan architecture. They just don't have a massive reuse infrastructure to feed, so holding a simple security interest is completely sufficient for them to manage their risk. Section 6. The family office scenario. Let's look at a real-world application. Let's anchor all these abstract legal concepts with a concrete, high-stakes scenario. Imagine a family office holding a highly concentrated FTSE 100 equity position that suddenly needs liquidity for a massive co-investment commitment. An institutional counterparty hands them a repo proposal offering 70% of the current market value, provided as cash, with a 30% margin haircut. What this legally means is that the family office's shares are being sold immediately to the institution at a massive discount. They are left with merely a contractual obligation to repurchase equivalent shares at a higher price later, at the end of the term. So here's a question for you. Between a specialist pledge and an institutional repo, which structure does the family office choose? Consider the risk profile differences we've discussed today. If they take the repo, they take on the extreme danger of becoming an unsecured creditor against an institutional counterparty they've never even transacted with before if things go sideways. The family office smartly chooses the pledge structure. They absolutely require that proprietary recovery claim from a segregated account. It's also worth pointing out that for corporate borrowers who hold shares above certain regulatory disclosure thresholds, selling those shares via a repo frequently isn't even a legally viable option anyway. It literally has to be a pledge. Which brings us to our final, pretty provocative question for you to think about. Does your current lender have the contractual right to reuse, rehypothecate, or repledge your collateral right now? The time to find out who actually owns your assets is at the term sheet stage, mapping out both the ownership and operational axes before you sign anything. You absolutely never want to wait until a stressful enforcement event occurs to discover you fell right into the collateral trap. Thank you so much for joining me to learn with this explainer. Until next time, stay focused and stay informed.